Listen, if you're watching silver close at $92 today, and you're thinking this is the top, what I'm about to tell you will change everything you thought you knew about this market. Billionaire Eric Sprott just went on record and revealed a mathematical formula, a calculation so simple yet so devastating that it proves $92 isn't even close to silver's real price. He's not talking about technical analysis. He's not guessing. He's using a geological ratio that's existed for over 2,000 years. And when you see this number, when you understand what the banks have been hiding, you'll realize we're not at the top. We're at a 70% discount from where silver is mathematically required to go, and the timeline, it's already started. Welcome, my friend, to Currency Archive, the only channel where we cut through the Wall Street noise and show you the real mathematics behind your money. Now, I need you to do something for me. See that subscribe button right there below this video? I know, everyone asks you to click it. But here's the thing. If you've been watching markets for 20, 30, maybe 40 years like I have, you know when something big is happening, and you want to make sure you don't miss a single update. So do an old timer like me a favor, hit that subscribe button so you get every breaking alert when these financial earthquakes hit, and tell me in the comments, where are you watching this from today? Are you in the States, Canada, Europe, Australia? I want to know where my fellow truth seekers are tuning in from. Because what's happening right now, it's global. Eric Sprott sits in his office in Toronto looking at a chart that most investors have never bothered to examine. It is not a price chart. It is not a technical indicator. It is a geological map showing silver and gold deposits across every major mining region on Earth. And what this map reveals is a mathematical relationship that has existed for over 2,000 years. A relationship that is now being violated in the most extreme way in modern financial history. Sprott is not a typical investor. He is a billionaire who built his fortune by identifying market distortions before anyone else noticed them. He made his first major fortune in the 1990s. He made his second fortune in the 2000s precious metals bull market. And now in 2025, he is making a prediction so precise, so mathematically certain, that he has staked his reputation on a single number. $300 per ounce of silver. Not as speculation, not as hope, as mathematical inevitability. The foundation of his calculation begins with a simple geological fact. For every ounce of gold that miners extract from the earth, they simultaneously extract approximately 8 ounces of silver. This is not theory. This is measured reality across every continent where precious metals are mined. In South America, the ratio holds. In North America, the ratio holds. In Australia, Africa, and Asia, the ratio holds. The Earth's crust contains these two metals in a fixed proportion, and no amount of human intervention can change this fundamental reality. The Romans knew this ratio. Ancient Chinese dynasties documented it. Spanish conquistadors observed it in the New World. For millennia, this 8-to-1 relationship has been the baseline reality of precious metal extraction. Sprott pulls up the data from the World Silver Survey. In 2024, global gold production totaled approximately 3,000 tons. Global silver production totaled approximately 26,000 tons. The ratio? Just over 8-to-1, exactly as the geological surveys predict. But here's where the story becomes disturbing. Gold currently trades at approximately $2,800 per ounce. If someone takes that number and divides it by 8, following the natural geological ratio, they arrive at $350 per ounce for silver. This is not a target. This is not a forecast. This is what silver should cost right now based purely on how these metals exist in nature. Yet silver trades at $92. The market is pricing silver at a 74% discount to its geological value. And this discount has been maintained for decades through mechanisms that Sprott has spent years documenting and exposing. He examines the current silver to gold ratio. At $90 silver and $2,800 gold, the ratio sits at approximately 30-to-1. The market is claiming that silver is 30 times less valuable than gold, even though nature produces them at an 8-to-1 ratio. This represents a 22-point distortion. 22 points of pure market inefficiency that exists nowhere else in the commodity world. Imagine if oil refineries produced gasoline and diesel fuel at a 1-to-1 ratio, but gasoline sold for $3 per gallon, while diesel sold for $90 per gallon. That distortion would last approximately 48 hours before arbitrage traders corrected it. Yet in precious metals, this distortion has persisted for over 40 years. Sprott reviews the historical data. In 1980, during the last major precious metals crisis, the silver to gold ratio compressed to 17-to-1. In 2011, during the sovereign debt crisis, it compressed to 32-to-1. Each time economic stress emerges, the ratio contracts toward the geological baseline, but never in modern history has it reached the true 8-to-1 ratio that geology demands. Until now. Sprott's analysis shows something different happening in 2025. The traditional mechanisms that maintain this artificial pricing gap are breaking down. The paper markets that allowed banks to suppress silver prices through unlimited futures contracts are facing physical delivery demands they cannot meet. The mathematical reversion has already begun. Silver has moved from $18 in early 2024 to $92 in early 2025, a 400% gain. And yet, according to Sprott's calculation, this move represents less than 1/3 of the total adjustment required to restore geological pricing reality. The Earth does not negotiate, geology does not respect central bank policy, and the 8-to-1 ratio has existed since before humans walked upright. Eric Sprott is simply betting that mathematics will eventually defeat manipulation. And if history is any guide, mathematics always wins. In a trading room in Lower Manhattan, a derivatives desk manages a position that should be mathematically impossible. The bank holds short contracts representing 150 million ounces of silver. But in their vault, allocated for actual delivery, sits fewer than 3 million physical ounces. This is not a scandal. This is not a secret. This is standard operating procedure in the modern silver market. And Eric Sprott has been documenting this structure for over 15 years. The COMEX Futures Exchange in New York processes billions of dollars in silver transactions every single day. Traders buy and sell contracts representing 5,000 ounces each. The contracts change hands electronically. Prices fluctuate. Fortunes are made and lost. But here is what most participants never realize. Less than 1% of these contracts ever result in physical metal changing hands. The rest settle in cash. This creates a fascinating phenomenon that exists nowhere else in commodity markets at this scale. The price of physical silver is being determined by a paper market where actual silver is almost never delivered. Sprott describes it as pricing a house based on a market where nobody ever moves in. The mechanics work like this. A bullion bank receives a signal that investment demand for silver is increasing. Retail buyers are purchasing coins. ETFs are seeing inflows. Physical demand is rising, which should push prices higher. But the bank does not want prices to rise. Higher silver prices create problems for their derivative books. Higher silver prices encourage more investment demand, creating a feedback loop. Higher silver prices draw attention to monetary metals, which threatens confidence in fiat currency systems. So the bank executes what traders call a slam. At exactly 8:30 a.m. New York time, or during the thinly traded Asian session, the bank dumps 10,000 futures contracts into the market within 60 seconds. This represents 50 million ounces of silver appearing for sale instantly. The algorithm-driven trading systems see this massive sell order. They interpret it as negative information. They begin selling automatically. Other banks see the price dropping and add their own sell orders. Within 5 minutes, silver has dropped $3 per ounce. No physical metal changed hands. No mine increased production. No industrial user reduced consumption. The entire price move happened in a purely digital environment. And then the bank quietly buys back most of those contracts over the next 3 hours at lower prices, pocketing the difference. Sprott has documented this pattern occurring hundreds of times over the past decade. He has shown congressional committees the evidence. He has presented the data to regulators. The pattern continues. But something changed in late 2024. The delivery demands started increasing, not from speculators, from industrial users who could no longer source physical metal through traditional supply chains, from Asian buyers who stopped trusting Western pricing mechanisms, from investors who specifically requested delivery instead of cash settlement. The COMEX maintains 2 categories of silver inventory. Registered. Silver is available for delivery against futures contracts. Eligible silver is stored at COMEX warehouses, but not available for immediate delivery. In January 2024, registered silver at COMEX totaled 78 million ounces. By December 2024, it had fallen to 41 million ounces. By February 2025, it stood at 28 million ounces. Meanwhile, open interest in futures contracts represented claims on over 900 million ounces. The ratio of paper claims to physical metal had reached 32-1. Sprott recognized this pattern. He had seen it before in other commodities, just before delivery failures occurred. The Hunt brothers in 1980, the palladium squeeze in 2000, the nickel crisis on the London Metal Exchange in 2022. Each time the exchange changed the rules to protect the banks and punish the buyers demanding delivery. But silver presents a different problem. Unlike nickel or palladium, silver has a 5,000-year history as money. Unlike other industrial metals, silver holds cultural and monetary significance across multiple civilizations. Unlike other commodities, silver investment demand can appear from hundreds of millions of individuals simultaneously. The banks can change COMEX rules. They cannot change human behavior across 4 billion people in Asia who view silver as savings. And they cannot create physical metal that does not exist. Eric Sprott watches the registered inventory numbers every week. He knows the mathematics of delivery defaults. He has calculated the exact point where the paper market loses credibility. And, according to his analysis, that point is approaching faster than most investors realize. The architecture of suppression is collapsing under the weight of physical demand it can no longer satisfy. A solar panel manufacturing facility in Jiangsu province, China, consumes 14 tons of silver every single day. The procurement manager responsible for securing the supply sits in his office reviewing contracts with growing concern. 3 of his regular suppliers have notified him of delivery delays. 2 others have increased prices by 18% in the past 60 days. One simply stopped responding to orders altogether. This is not a temporary shortage. This is the beginning of a structural deficit that Eric Sprott has been warning about since 2019. The solar industry alone is projected to consume 185 million ounces of silver in 2025. That represents nearly 20% of total global mine production. And solar deployment is accelerating, not slowing. Government mandates across Europe, China, and North America are requiring renewable energy installations at unprecedented scales. Each solar panel requires approximately 20 grams of silver. The metal's unique properties make it irreplaceable. Silver has the highest electrical conductivity of any element. It has the highest thermal conductivity. It reflects 95% of the light spectrum. Engineers have tried substituting copper, aluminum, and other cheaper alternatives. The efficiency losses make substitution economically impossible. But solar is only one piece of the demand equation. In Stuttgart, Germany, an automotive electronics supplier is redesigning circuit boards for electric vehicle charging systems. Each vehicle requires between 25 and 50 grams of silver for electrical contacts, circuit boards, and battery management systems. The company's projections show demand increasing from 2 million vehicles in 2023 to 18 million vehicles by 2027. That represents an additional 61 million ounces of annual silver demand from the automotive sector alone. Meanwhile, telecommunications companies are deploying 5G infrastructure across Asia, Europe, and North America. Each 5G base station contains approximately 3 kilograms of silver. The build-out plans call for 13 million base stations by 2028, another 130 million ounces of annual demand. Medical device manufacturers are incorporating silver into antimicrobial wound dressings, surgical instruments, and diagnostic equipment. Water purification systems are using silver nanoparticles. Electronics manufacturers cannot build smartphones, computers, or tablets without silver contacts and circuit traces. The industrial consumption number for 2025 has reached 618 million ounces. This is not speculative demand. This is not investment demand. This is physical consumption where the silver is used and never recovered. Now add investment demand to this equation. In 2024, global silver ETF holdings increased by 87 million ounces. Retail coin sales from government mints reached 242 million ounces, the highest level in 12 years. Asian buyers, particularly in India and China, purchased an estimated 165 million ounces for jewelry and investment combined. Total investment demand for 2024 exceeded 340 million ounces. Eric Sprott sits with these numbers spread across his desk. Industrial consumption at 618 million ounces. Investment demand at 340 million ounces. Total demand approaching 960 million ounces annually. He pulls up the mine production data. Global silver mine production in 2024 totaled 843 million ounces. Recycling added another 173 million ounces, bringing total supply to 1.016 billion ounces. The market appears balanced until someone examines the details. 70% of silver comes as a byproduct of mining copper, lead, and zinc. When copper prices decline, copper mines reduce production, and silver supply drops automatically. Miners cannot simply produce more silver in response to higher silver prices when they are primarily extracting other metals. Primary silver mines, where silver is the main product, are depleting. The average ore grade has declined from 12 ounces per ton in 1990 to fewer than 6 ounces per ton in 2025. New mine development requires 7 to 10 years from discovery to production. No major new silver deposits have been discovered since 2018. Sprott examines the inventory data with particular attention. Above-ground silver inventories held by exchanges, ETFs, and documented storage facilities total approximately 2.8 billion ounces. That sounds substantial until someone calculates how long those inventories last under current deficit conditions. At a 50 million ounce annual deficit, those inventories last 56 years. But deficits are accelerating. If industrial demand grows at projected rates while mine production stagnates, the annual deficit reaches 180 million ounces by 2027. Suddenly, those inventories last 15 years. And that assumes no panic buying, no investment demand surge, no recognition by pension funds and sovereign wealth managers that silver is dramatically undervalued. The United States government once held 3.5 billion ounces of silver in strategic reserves. They sold the last of it in 2002. China holds undisclosed amounts, but has been a net importer since 2005. No government maintains strategic silver stockpiles anymore. There is no cavalry coming to rescue this market. Eric Sprott sees the mathematics clearly. Demand is rising structurally and irreversibly. Supply cannot respond. Inventories are the only buffer, and they are finite. The price must rise until demand destruction occurs. And given silver's industrial necessity, the price might be substantially higher than $300. Eric Sprott opens a spreadsheet that contains 3 scenarios. Each scenario uses different assumptions. Each produces a different silver price target. But even the most conservative calculation arrives at a number that makes $90,000 silver look absurdly cheap. He begins with the base case, the geological ratio restoration. Gold currently trades at $2,800 per ounce. The Earth produces silver and gold at an 8-to-1 ratio. Simple division yields $350 per ounce as the fundamental value for silver. But Sprott adjusts this number downward slightly to account for silver's greater industrial consumption, which removes metal from the investment pool permanently. His base case target, $320 per ounce. This scenario assumes no panic buying, no currency crisis, no COMEX delivery failure, just a gradual recognition by institutional investors that silver is mispriced relative to gold based on geological scarcity. Timeline for base case, 24 to 36 months. The bull case scenario incorporates historical precedent. In 1980, the silver to gold ratio compressed to 17-to-1 during the Hunt brothers accumulation. But before that, in 1979, it briefly touched 12-to-1. During periods of monetary stress, investors have historically overweighted silver relative to gold. If gold remains at $2,800 and the ratio compresses to 5-to-1, silver reaches $560 per ounce. Sprott considers this unlikely but mathematically possible during a hyperinflationary crisis or complete loss of confidence in paper currencies. Timeline for bull case, 36 to 60 months, requiring a major monetary system disruption. The conservative case assumes partial ratio correction. Instead of full reversion to 8-to-1, the market only corrects halfway to 15-to-1. This still produces $186 per ounce silver, more than double the current price. Timeline for conservative case, 12 to 18 months. But Sprott's analysis goes deeper than simple ratio calculations. He examines catalyst probability. The COMEX registered inventory stands at 28 million ounces. Open interest represents claims on 900 million ounces. If just 5% of contract holders demand physical delivery simultaneously, the exchange faces a 17 million ounce deficit. The probability of a delivery standoff has increased from 12% in 2023 to 34% in early 2025, based on Sprott's proprietary stress models. A COMEX delivery failure would trigger immediate price discovery in physical markets. His calculation suggests a 40% to 60% price spike within 72 hours of such an event, followed by sustained premium pricing for physical metal over paper contracts. Currency debasement represents the second major catalyst. The US dollar money supply has expanded by 37% since 2020. Real interest rates remain negative after adjusting for actual inflation. Every major central bank continues deficit spending financed by monetary expansion. Sprott's currency debasement model suggests that if M2 money supply grows another 20% over the next 2 years, which current trajectories indicate as probable, then all hard assets, including silver, must reprice proportionally just to maintain purchasing power parity. This alone justifies $110 to $125 silver within 18 months, independent of supply-demand fundamentals. Geopolitical supply disruption forms the third catalyst. Mexico produces 23% of global silver. Peru produces 18%. Any political instability, nationalization threat, or trade restriction in these regions immediately removes 200+ million ounces from global supply. The probability of such disruption has increased from 8% historically to 22% in current geopolitical environment, according to risk assessment models. Sprott examines his own positioning as validation of his thesis. His personal portfolio allocation sits at 28% physical precious metals, with silver representing the majority. Sprott asset management funds, under his influence, hold over $4 billion in silver-related investments, split between physical metal and mining equities. He recommends a barbell strategy for investors: physical metal for wealth preservation and insurance against systemic failure, mining equities for leverage to price appreciation, accepting higher volatility. But he emphasizes one critical point that separates informed investors from gamblers. The timeline is uncertain. The mathematical destination is not. Silver at $92 represents a 71% discount to the $320 base case target. It represents an 84% discount to the $560 bull case scenario. Even against the conservative 186 target, current prices offer 102% upside. Sprott reviews the historical parallels one final time. In the 1970s, gold rose from $35 to $850, while silver climbed from $1.50 to $50. A 24x move in gold, a 33x move in silver. Silver outperformed due to smaller market size and greater elasticity. The current setup shows similar characteristics. Gold has already doubled from its 2018 lows. Silver is just beginning its catch-up phase. Eric Sprott closes his spreadsheet and looks at the digital ticker showing silver at 92 on opportunities. He does not see the current price. He sees mathematical inevitability expressing itself in slow motion. The geological ratio existed before humans discovered these metals. It will exist long after current market manipulations are forgotten. In mathematics, Sprott knows from 50 years of investing, always wins eventually. The only question is whether investors recognize the opportunity before the reversion completes.